Hello, and thanks for joining the Pantheon webinar. This is Jay Cheatham. I'm in Texas. Also presenting and on the webinar for us are Justin Hondris, our financial director in London, Bob Rosenthal, our technical director in California, and this morning, because everyone's working from home, Bob's web went down, so he is actually dialed in and not in through the internet. And from Alaska, Michael Duncan, our VP of Operations. And Michael was the primary contact with Lee Keeling, and he'll be talking more about that later. We're doing this webinar. It's in unprecedented times with the COVID-19 virus sweeping the world, with the economic activity in declining rapidly. There's massive demand destruction, especially in the travel, the hospitality, and the energy industries. Saudi Arabia and Russia are in an energy price war. It has sent prices falling from plus $60 a barrel in early January for West Texas Intermediate to approximately 25, actually a little less than $25 a barrel today. Art Berman has done some analysis for us using the actual IPO materials for Saudi Aramco. So it's the first time we've ever been able to actually see real numbers for Saudi Aramco. And that work is actually later on in the presentation, but I wanted to use it in the preamble today. Saudi Aramco's break even is $28.88 a barrel. That's for a Saudi blend on the water at Ras Tanura. If you add transportation and a quality differential, that equates to a plus $30 WTI just for Saudi Aramco to break even and not give any money back to the kingdom. So we know these oil prices cannot last forever. However, we would be totally naive to believe that this combination of the COVID-19 shock and the oil price shock will not impact the overall industry and our farm out. Because for E&P companies, the exploration budget is the easiest place to cut. So what we will show today is some very recent work that's a result of merging several 3D data sets and extensive work on our trap geometry. And Bob and Michael will both talk more about that. And Bob and Michael will be giving most of this presentation. So this is the forward curve for West Texas Intermediate as of Thursday night. It was anchored around $25 a barrel and became asymptotic at about $45 a barrel. So the very smart money also believes that these oil prices are not sustainable. And we have used this in our economics, and Michael will be showing you more of those economics later. So this is what we use for our base case today. But from a historical perspective, and I've been in the industry for 55 years, I took a piece of a well when I was 17 years old and got hooked on the industry then. The Texas Railroad Commission was the original oil cartel because they control production in the state of Texas. And that worked until OPEC came along and had the 1973 and 1979 oil price shocks. The first one, oil went from $3 to $9, and then the second one in 79, it went from $9 to $30. Fast forward, and we had peak oil and $100 West Texas Intermediate and $8 an M natural gas, we had the shale oil boom, and now we have an oil price war. But it won't last, and we know it won't last, and major oil companies understand that it won't last. And just recently, in fact, in the last week, we had one national oil company sign a confidentiality agreement and is pressing us to get into the data room. Obviously, things are going to be a little bit different with travel restrictions in terms of how we get people into the data room, but fortunately, we've set up a virtual data room for a portion of our data. Now I've got we call it the resource pyramid, and I'm going to turn it over to Bob because he is much better than I am at explaining this. So Bob, will you take over, please?
Hello. Hello, everyone. I'm not used to, being in front of a group and not being able to wave my arms around, so I'm constrained. But anyways, this is the, what we call our resource pyramid. Some of you have seen this before, but today we're going to be talking about different things: reserves, contingent resource, prospective resource, technically recoverable resource. And you see these terms in the industry, and they're used by various groups. At the top of the pyramid, what everybody's trying to get are reserves. That's what people commonly call P1s and P2s, because this is where you can go to the bank and borrow money. It's the transformative moment for oil companies to move and have reserves that are actually as being able to take those information and get debt from it. What we have as of early this year was a contingent resource given to us on the Alkaid FECTA. That is a big step from moving from technically recoverable resource to a contingent resource. Each one of these statements, reserves, contingent resource, and prospective resource, those statements or those numbers come usually from independent experts, and they're well defined. They are defined by the Society of Petroleum Engineers. So each one of these moves up the pyramid is defined by certain criteria. For us at Alkaid, last year we tested the well. We got a flow rate of 100 barrels a day. We have the 3D seismic, and we were able to get a contingent resource from Lee Keeling and Associate. Now remember, contingent resource is going to be a subset of your technically recoverable resource, because it's always a number that is confined by the data that you've actually captured at any period of time. As when we move from contingent to reserve, that number will be, smaller at first stage, will be smaller than the contingent resource, because again, it's a limited amount of information, and you progressively move to bigger numbers. Now, that doesn't mean that you'll never get to, your full technically recoverable resource to alter reserves. And as Jay and I, who've been in the business for a long time, we have seen really good fields move from, sort of X, technically recoverable resource to 2X reserves. So, but at this stage we're at, we are moving from, technically recoverable to prospective to contingent, then to reserves. And I think what you need to keep in mind for everybody that's new to this presentation, for us having this, 70 million barrel plus contingent resource at Alkaid is a huge, huge win. If Jay will talk about it later, you must remember that back in January of last year, we were talking at a P50 technically recoverable for Alkaid and FECTA of about 60 million. We now have a contingent resource that combines those two features as one and have a contingent of 76.5 million. So that is one of the big messages that everybody should keep in mind. And with that, I think I'll turn that back over to Jay.
Okay, so many of you have seen this before as well. Bob talked about Alkaid. Michael will talk more about it. I'm gonna focus a little bit on the Talitha project right in the middle of that. So Talitha contains 3 zones of interest. Now we're going to confuse you terribly today because we have changed our nomenclature, and we had to change our nomenclature because we found the trap geometry was different than we had imagined going into it. We look at the Pipeline State number 1 well, which was drilled in 1988. It has a 2,200 foot oil column. At the top, it has the shelf margin deltaic, and it has the slope system, the floor fan system, and the caparic under it. All of those have different trap geometries. So we have had to split those out as we work through them. We are only going to talk in detail about the shelf margin deltaic today, and that is the uppermost portion of you will later see the log of the Pipeline State number 1 well, the upper 20% of that 2,200 foot oil column. And out of that 20%, we have determined that there's 1.8 billion barrels of oil in place in the shelf margin deltaic feature, with a P50 technical recoverable resource of 483 million barrels. Previously, for the entire Talitha project, we had about 2.6 billion barrels of oil in place and about 500 million recoverable. So just think about that. If I came to you and said, we've just completed a well, we've only evaluated the top 20% of a 200 foot column. It's got 1.8 billion barrels in place. We think we can recover 500 million of it, and it's in a down dip position. We'd all be turning cartwheels if I could, but that's what we're going to be talking about today. We also have our new projects at Theta West and Leonis, where we were the successful bidder and got about 28,000 new acres, and we're really excited about both of those projects as well. Those are also keyed off of key wells that have hydrocarbon shows and strong electric log indicators. Recent history, I'm gonna go ahead, Bob.
Up for a second.
Absolutely.
So I think, just looking at this slide, I think Jay's right. We're trying to introduce to our shareholder base our new perception of what we have now. And the important thing is, and this is going to be a reoccurring theme throughout this discussion, is we have the Greater Alkaid project, but what we used to call Talitha and Theta West, we are now telling you we have 3 very large separate trap and reservoir accumulations. And in there, and this again, in Talitha, what we're going to be discussing is the Talitha Brookian section, which we break out into 2 parts, and that has a separate super trap. We have the Talitha Caparic, which is again a completely separate reservoir from the Brookian section. That has a huge trap and reservoir, a completely different reservoir configuration from the Brookian above it. And then what was called the basin floor fan in Talitha, we now know that that is part of the Theta and Theta West complex. And those 3 projects each are extremely large accumulations. And what you're going to be seeing today with Michael, what you're going to be seeing today of Michael is just one segment. He's going to go through the shelf margin deltaic system in the Talitha Brookian trap. So just keep that in mind. We are trying to get that information all out to the shareholders.
Very good, Bob.
I'll turn that back over to you, Jay.
So this is just a recent history. We did the merger. We got the independent report from Lee Keeling. We confirmed the discovery at Alkaid and now Greater Alkaid. We're going to talk more about the upper zone at Talitha. We did the strategic collaboration / partnership with eSeis. We've commenced and we're continuing to work the farm out. Don't want anyone to, we are continuing to work all of this data. We are upgrading it and we're continuing to work the farm out. And we greatly enhanced our acreage position with the 28,000 acres that we acquired at the December lease sale. Now, this is a North Alaska. You can see Prudhoe Bay, and just to the west of Prudhoe Bay, Kuparuk. Prudhoe Bay has 32 billion barrels of oil in place. West of that, of Kuparuk, we've got the Horseshoe Pika discoveries by Oil Search, Repsol, and Armstrong. And just west of that, which is very critical for us, is the Alpine field. The Alpine field, the original G&G work at Alpine was done by the founders of eSeis when they were at Union Texas Petroleum. So they worked up this play at the time. ARCO was a partner with Union Texas in the field and had the majority of it. And they went to ARCO and said, we think there's a play here. ARCO declined and Union Texas Petroleum drilled the Alpine field and made a huge discovery. Alpine to date has produced 500 million barrels. Now, ARCO ended up acquiring Union Texas Petroleum, so they ended up getting the portion of the Alpine field back that they had lost through going non-consent. But you can see our acreage outline. The red is our 3D seismic. You can see our Talitha project, our Greater Alkaid project in the ovals, and our Leonis. And back to Prudhoe Bay. Prudhoe Bay was discovered in 1968. It is the factor of why I went to work for Atlantic Richfield. When Prudhoe Bay was originally discovered, the original numbers on Prudhoe Bay were 10 billion barrels of oil in place and 3 billion barrels recoverable. We now have 32 billion in place and recoveries are at 14 billion barrels. The reason I point that out is good fields get bigger and better. And Prudhoe Bay has a footprint of about 215 or 220,000 acres. And when Michael shows you the footprint of and Bob, the footprint of our acreage positions, these are cartoons that you can see here. We have about an 80,000 acre footprint around our projects. And as we mentioned, the oil column in the pipeline state number 1 well is 2,200 feet. The original Sadler-Rochert reservoir that was produced at Prudhoe is about 400 feet, and they're now drilling wells into 40-foot sections of Prudhoe Bay. Most everyone has seen this. It just shows where Prudhoe Bay is and Dead Horse with relationship to Alaska, right up on the North Slope. The pipeline coming down from Dead Horse to Valdez, 787 miles. The Dalton Highway runs right along beside it, and you can see our acreage block it's showing up in green on mine. Also of note, down below is the TAPS throughput, which at one time exceeded 2 million barrels of oil a day and is now down around 500,000 barrels of oil a day. So there's much spare capacity in the Trans-Alaska pipeline system, and the state of Alaska would like nothing more than for us to be producing large amounts of crude oil to put into the pipeline so they could get their tax revenues. This is a better outline of our 3D seismic and our projects, and you can see the areas that we added in the December lease sale, Theta West and Leonis. And of real note, also on here is the Alkaid well, the Pipeline State #1 well, and the Charlie 1 well that's being drilled by 88 Energy. Michael, could you put an arrow on the pipeline well? There, thank you very much. So just remember that we have multiple reservoir systems keyed off of this Pipeline State #1 well, trending to the west-northwest, and further up at Leonis, that system also is keyed off of a well called the Tulik Fed, which is right below Leonis there along the river. And I'm going to turn it over to both Bob and Michael. First to Bob, and oh wait, let me go through this real quick. This is just our portfolio that we're appraising and reclassifying. Greater Alkaid, as Bob said, we had 60 million barrels technically recoverable a year ago. Now we're at 90 to 135, and 76.5 million contingent resource, 900 million oil in place. The shelf margin deltaic at Talitha, 1.8 billion in place, 483 technically recoverable. The slope fan system, which is right underneath that, is under review. The Kaparic, which is the deepest formation in our Talitha and is the deepest penetration of the Pipeline State #1 well, also under review. Theta West, where we believe there's greater than 3 billion barrels of oil in place. It's the Brookian Basin floor fan. We have an upgrade that's anticipated there and an upgrade anticipated at the Kaparic, also under review. Leonis, where we showed you the Tulik Fed well just south of that, under review, and Megrez is also under review. So, Bob, I don't know if you want to add anything more on this. I'll turn it over to you.
Yeah, again, I just want to highlight for everybody is think of Talitha Brookian as a separate trap with different reservoir geometry than when you talk about Talitha Kaparic or Theta West. But Talitha Brookian is a very large trap. Talitha Kaparic, extremely large trap, and again, completely separate reservoir geometry to the Talitha Brookian. And then Theta West is the basin floor fan that we see in Pipeline State #1, but again with a completely different trap geometry and reservoir distribution than the other two large accumulations. So each one of these is, are three separate accumulations, but they're stacked on each other. And that stacking on each other gives us an amazing sort of resource density, and that's what makes this acreage look so unique. Geologically, obviously it's positioned to the pipeline and things like that, have, kind of wonderful operational upsides. But geologically, we're stacking these three potential very large accumulations, one right on top of the other. And I'll leave that and pass that on to Michael.
Okay, hello everybody from Alaska. We're going to discuss in the following slides the greater Alkaid discovery. But before I do, I want to play a quick video for you. Just a reminder of the Alkaid and what we're really after. This is an oil sample taken from the Alkaid well from the test separator on location in March of 2019. It tested at 35 API gravity, and as you can see from the video, is very thin, very light crude. It's wonderful sweet oil, beautiful stuff. So I wanted to start with that just because it's, well, to be honest, it makes me happy. It's a wonderful example of the oil there, and that sample I took from the separator almost a year ago today. So very excited about the project and what this means, and I think that's a wonderful exhibit to show what we're really after. To give an overview of the Alkaid well, it was drilled in 2015, and that was a year of a very anomalous weather event. The river, the Sag River near location, had an off-ice event and overflowed across the highway. This overflow of the highway shut down the only transportation corridor to the North Slope of Alaska and also severed our connection to Prudhoe Bay. And thus we had to case the well and leave location as quick as we could. We were able to button the well up, but do nothing else. As I said, a year ago, we went back to the Alkaid well, March 2019, and had a very successful test, exceeding our expectations. With 450 feet of gross pay identified in the well and 240 feet of net, we were very excited to go in and test. But the vertical well was a stratigraphic well. It was not intended to maximize flow. It was intended to investigate the reservoir. And that put us in a constraint where we had to focus the completion in the vertical to a 6-foot interval to ensure we made proper contact with the reservoir. And of that 6-foot interval, out of the 240 feet of pay, through that 6-foot interval we flowed 100 barrels of oil a day. And as discussed earlier, that exceeded our expectations quite significantly. Since that test a year ago, we've had some great progress on understanding the reservoir because of the results. And most of all, the big result is that we've got a contingent resource report from an independent expert firm of 76.5 million barrels of oil in place. In that contingent resource report, they give the NPV10 for the project of $595 million. We're very happy with this result. It certainly showcases the proven nature of the reservoir and the success we had in the well, and also affirms a lot of our engineering that went into it in advance. So it's been a year of affirmation for the Alkaid well as we progress from concept to reserves, and we're on our way there. Very happy with the contingent resources. Furthermore, in the contingent resource report, they gave an estimated ultimate recovery of 2.25 million barrels per well. This is similar to the recovery we estimated, and we feel this is further affirmation of our process, of our engineering, and of our geology. And 2.25 million barrels per well is exciting in any oil field, even here in the North Slope. We're very happy. This is indication of a lucrative and very successful development that we hope to begin soon. In the development, we forecast a peak flow rate for the wells of 30,000 barrels of oil a day. So it's a very thorough analysis has been done, been reaffirmed by independent experts, and showcases that this reservoir is proven and has significant deliverability in the future. To talk just a moment on a side note, the picture here was one I took, and it was actually taken the day that the well flow tested. The trucks you see are the nitrogen lift, and this picture was obviously at sunset. Fortunately, the sunsets up there last about an hour long this time of year. And so it's one of these magical days where we suddenly had oil in the separator, The samples looked fantastic, a lot of excitement on location, and the day closed with this amazing sunset. So we were able to sit up on top of the rig in about 5 below Celsius. Just a beautiful day where everything came together, and we all got to sit up on top of the rig and watch the sunset after a successful load test. This is a very special picture to me because it was such an amazing day out on location. Backtrack a little and talk about the well itself. We spoke of the well as a vertical. It was a stratigraphic test, and that was drilled because no well before that had penetrated the reservoir. And so this is a petrophysical interpretation of the pay, and you see it zoomed in on the right-hand side. You see the gross pay showing a significant oil column, over 450 feet, and we never got out of reservoir. So we called TD on the well before we found the bottom of the reservoir. It's very, very exciting for us. Also shown but hard to see is a very small green square that was our perforated test interval. And so I offer this image to show not only the oil column, but to show that because of the well configuration, we focused our test on a very small portion of it. We feel this is just a sample of what the well could do and what the formation could do, and look forward to showcasing the true delivery wells.
Can I just jump in for a second?
Please.
So yeah, that's all right. Again, we penetrated about 450 feet of gross pay, but we know we have an isopack here, or a thickness section that we were going to test of about another 450 feet. So this is a perfect place to think about what Lee Keeling had to do. So we had what was called an oil down to. So at the very base here, we had sand with hydrocarbons in it, and that was their constraint in terms of how much pay or gross column they could give us. But in terms of the upside, and what we see another 400 or 500 feet below this that could have potential pay in it. This oil down to is what also gave us the opportunity to recognize that Alkaid and what we called Thecta, which we thought was a separate trap, were actually one and the same trap. So this information, plus our 3D seismic, some of which we only got in the middle of last year, we were able to remap the structure with the oil down to, and we believe that it was one accumulation. And again, the Lee Keeling group agreed with that. So, but when we are appraising, when we're going out and when we're going to appraise this project, we will be testing the deeper interval as well. Sorry, Michael, I'll let you go.
Thank you, Bob. To dive in a little more about what Bob indicated and also what the Lee Keeling report, our independent expert report, affirmed, is a development plan for the reservoir. And what you see here is the map of the amplitude response overlaid with a development plan of the wells. In the darker green are areas where the amplitude map mimics that was cut by the Alkaid reservoir. And as such, these wells were forecasted to produce 2.25 million barrels of oil apiece. The additional development plan wells shown in the lighter green, both in between those two sections and to the south of those two sections, are areas where the amplitude response was different than that of the Alkaid well. Our geology and geophysics indicates that that's all still reservoir, but in order to capture the fact that the response was slightly different on the geophysics, Lee Keeling and Associates discounted the well production in those intervals by 50%. And so those wells were forecast to produce 1.125 million barrels apiece. We don't necessarily share the belief in that discount, as we have 450 feet of reservoir and we're forecasting only developing about 225 feet of reservoir at a time. And so we believe there's significant upside over what was included as contingent resource. But we understand that this is the next step, moving from prospective to contingent resource. And we're very happy that we've upgraded 76.5 million barrels. We believe ultimately the reservoir has much more deliverability, and that by extrapolating the 2.25 million barrel wells on, we get to almost 100 million barrels. That'd be 99 million barrels by these wells in this development plan. But we also believe there's opportunity for additional wells, and we'll learn more about that as we move into this development plan and as we begin to further appraise the reservoir.
And I just want to state we perceive this as a 100 million barrel discovery. We've got a contingent resource of 76.5 million. This is a giant oil field sitting next to one of the most underutilized, infrastructures in the world, the taps. That pipeline in there is got a spare capacity of over 1 million barrels a day. We are the only company that are at this point in time. We are the only company at this point in time that has a new discovery right next to this infrastructure. And as Michael will, tell you in the next several slides, we can develop this and be on production and have year-round sort of drilling because of the location of this discovery.
Thank you. As Bob mentioned, and that's an excellent time to highlight that point. The stars seen in this slide are development locations, and as you can see, they sit adjacent to the Dalton Highway. Conventional methods in Alaska are to first install ice roads for testing so as not to damage the tundra. And then after a year or two of appraisal and a year or two or maybe 3 years of environmental impact studies, then gravel roads are put in place and development on reservoirs begins. We're in an extremely fortuitous situation where we currently have a highway going directly over these locations. And so we don't have to do the appraisal program on ice, nor do we have to do the environmental impact study because the road already exists. We're very fortunate. We can put a pad on the Dalton Highway, drill, operate year-round, and move to sales through trucking immediately, bypassing what is conventionally about a 5-year program here in Alaska. We can move into sales immediately. And that is captured by the report. And I want to talk just a little bit more about the independent expert report. Lee Keeling and Associates is out of Tulsa, Oklahoma. They've been in business since 1957. We selected Lee Keeling and Associates because we've had historical operations with them and very much like working with them. But furthermore, they're in the epicenter of a lot of the new drilling and completion and reservoir development technologies that have come to pass in the last 5 to 10 years. So they have a lot of large customers who use development plans just like this. They're very familiar with the development plans. They're very proficient in understanding how to apply that development to a reservoir. And thus it's showcased in the contingent resource report because they highlighted exactly how those technologies can and should be applied to this reservoir. And the results, as we spoke of, are very encouraging. 76 million contingent resource with 600 million NPV10 in their report. This technique. Go ahead, Bob.
Michael, I'm sorry to jump in there. I just want to say something about Lee Keeling, which I've mentioned in the past. Lee Keeling was introduced to when I say us, this is a while ago. Lee Keeling was introduced to the predecessor of Pantheon, which was Great Bear, was introduced to us by one of the heads of engineering at Halliburton. They actually recommended that them as being appropriate for looking at a similar project to this. Where horizontal drilling and frac technology were going to be used, and they were recommended to us by Halliburton. And the guy who was running Great Bear at the time was the ex-head of engineering for BP, and he took their recommendation. And again, they all thought they had done a good job. So again, don't look at size, in terms of determining, who's good and who's not good. These guys were highly, highly recommended to us from Halliburton.
Thank you, Bob. The last thing I want to highlight in this presentation on the Alkaid contingent resource report is that we modeled about a 10% recovery factor. I want to highlight that because that is not a aggressive recovery. There's a lot of reason to believe that that recovery is conservative. We have strong fluid mobility. We have very thin oil. There's a lot of reason to believe that a solution gas drive would actually result in a very good flow and a higher recovery. But as we progress from prospective resources to reserves, this 10% recovery factor is a very achievable factor. And so there's a lot of reason there to believe that there's an upside on top of the recoveries forecasted in this report. We're very, very happy working with Lee Keeley and Associates, very happy that our concept of reservoir and our development plans and our fluid mobility and producibility has been affirmed. With that, I'll turn it back over to you, Bob.
So before we go into the discussion about the Talitha shelf margin deltaic development and the resource potential, I wanted to give a quick update and review of what Talitha and Theta West even look like, and also show it in relationship to the Charlie well. So first, let's go back to the pipeline. If somebody could move the slide, I'm looking at the pipeline state well. And so what I want to do is just review the pipeline state well. In this well, we intersected over 2,000 feet of oil-bearing columns. So we've got a huge sort of section here that is all hydrocarbon bearing. We've broken it out into what we call the shelf margin deltaic and the slope fan. Now, I want to emphasize two things here. One, the shelf margin deltaic is the reservoir that is very much akin or analogous to the discoveries at Horseshoe and Pica. Same set depositional environment, and we'll have the same sort of reservoir geometries that they see at Horseshoe and Pica and part of the Willow discovery. Nothing different. The slope fan, very, very similar to what we've got at Alkaid and Theta. The super trap, the Talitha Brookian super trap, is made up of the shelf margin deltaic and slope fan system. Beneath that, which we were calling the basin floor fan section, we now know we've intersected that in Theta West. So Theta West, that project has actually intersected the pipeline well at the basin floor fan, and that is oil bearing. When I say it's oil bearing, we know that because we have core data through it. We have core data through the slope fan system. We have core data through the shelf margin system. There was literally oil to surface while they were drilling through those sections. But the slope, the Theta West is completely, the trap geometry of Theta West is completely independent of the slope fan and shelf margin deltaic system that we have in the Talitha Brookian trap geometry. And below that, we have the Talitha Kaparic, which is a completely separate trap and reservoir geometry. So next slide. So that's a seismic line going from, on the west, the Charlie 1 well, which is they're drilling off of what was an old Exxon well, a BP well called Malaguk. And on the east, on the right-hand side of the line, we have pipeline state. In the green circle, we have highlighted the Talitha Brookian sort of super trap, and then theta west. And theta west, as you see those large amplitude anomalies in there, actually intersects the pipeline state well in that the bottom part of the pipeline state well, and that is the Brookian basin floor fan section. So we have over 400 feet of hydrocarbon bearing zone in the pipeline state well, down dip from this huge AVO amplitude anomaly and trap that we call theta west. It is extremely large aerially. Now, I want to step back and talk a little bit about the work that eSeis has done and highlight again what Jay said. The two guys that found Alpine at back in the early 90s for Union, Texas, have been working on that project. What was critical about Alpine was it was the first time on the North Slope anybody used all this high-tech geophysics, this AVO amplitude geophysical analysis to find hydrocarbons. These are the two guys that did it. Nothing different here in terms of the work they are doing. And at Alkaid, we have proven that it works. This is not too far away from Alkaid. This work has been proven to show that we can identify hydrocarbon-bearing reservoirs in this section. So what we're looking at Talitha and what we're looking at Theta West is we are doing all this high-tech geophysics. It helps us with our analysis of the track geometry, but also reservoir distribution. So what I'll do is I'll go to the next cartoon and just talk a little bit about the relationship between Charlie West and Charlie 1 and Theta West and Talitha. So here's kind of a simplified sort of cartoon of what's going on. And highlighted on the right is what we call the kind of the Talitha Brookian super trap, which includes the shelf margin and slope fan reservoirs. And you see there on the cartoon, it's this very large onlap, and you see the dashed yellow that we've been able to map out. And that is completely separate from what you see there at Theta West, which has a completely different track geometry. The way I understand the Charlie number one well being drilled right at the moment is their primary target is the Torok stellar basin floor fan sands down there. So at the very bottom of the well, that is their primary target. They're going through these other targets, but I'll just talk about the basin floor fan target, which is in the Torok and which is in a different age reservoir than what we're looking at. So the stellar sands are Torok, they're older, and they are deeper than what we are targeting at Theta West and at Talitha. So our belief is they're going to find hydrocarbons there. We strongly believe that, that they're going to find hydrocarbons. We don't have their 3D. We only have 2D, but it's location to the old BP well. I think they're going to find hydrocarbons, and they're going to test it. Any positive test of their well is significant for us because, again, their reservoirs older and deeper. It's always better to be shallower. So we're looking at similar reservoirs but younger and shallower at our well. We have been in communication with the guys at 88 Energy, and they've been in communication with us, and we have told them anything we can do to help, we're there. Because, again, any positive indications for us are significant for our acreage.
Bob, to interrupt you,
my view is, sure, go ahead.
Speak briefly on that. They should be cutting pay as we speak. And despite some of the coronavirus complications we're having here in Alaska, I understand personnel have been able to mobilize and that the operations are continuing forward well. I've not gotten an update on any results from cutting the Brookian pay, but I do know that operations are moving forward and that the service providers in the industry here is responding to the current situation and keeping the foot on the gas pedal, so to speak.
So that's where I would like to leave it. If they have problems or they don't find hydrocarbons, that doesn't affect us at all. We are in a different reservoir, and we are shallower than they are, and we are tying our data off of the Pipeline State well, not off of the old BP wells. But we wish them a lot of luck, because anything that shows, that they can get movable hydrocarbons at depths of 10 or 11,000 feet is hugely significant, because that's the big step forward. So I'll go to the next slide. So I'm going to spend a few minutes on just Theta West and highlight Theta West. That is the log pay in the Pipeline well, over 400 feet of log pay. I mean, that's a significant section in itself. This colorful display is one of the E-size displays. And what you see there and highlighted is the AVO amplitude anomaly that makes up Theta West, and the intersection of the Pipeline well at the very bottom there, where we've got hydrocarbons in the well. Anywhere in the world, anywhere else in the world where we know that when we're going up dip on Theta West, we're actually going into what we believe are better reservoir conditions. We've got the AVO. We have all these geophysical anomalies. We've again tested this out at the Alkaid well. Anywhere else in the world, in let's say deep water, West Africa or Guyana, this would be classified as a discovery with having that well penetration in it and having the 3D and this sort of geophysical analysis. This is going to be a very large accumulation. It's the potential for is going to be really big. We're working on it now. We don't have the numbers for you, but we will get them. But that is just screaming at you, that is hydrocarbon bearing. Next slide. And I'll turn it over to Michael to go into detail on the shelf margin deltaic for the Theta Brookian.
Bob, did you want to talk about
Sure.
your seismic lines keyed off the Pipeline State and the Tulik Fed?
Oh, I thought I'd had it up. Did you want to go? Sorry, this could be my where. Which slide are you
all
on?
Right. Well, we had the we hadn't put this up, but if Michael, if you'll just circle the.
Okay, guys, let me go back then. I apologize. Again, I'm working, obviously working from home, and my area, everybody's working from home right at the moment, and they're like really, using the full bandwidth of the internet. And so I've had to do this on the phone. I should have told them to move up to slide 20. So let me take you through that again. So slide 20 is an AVO, E-size display. In red is this very large amplitude and AVO anomaly that we continually talk about is indicating hydrocarbons. But more importantly, it's not just indicating hydrocarbons. At the very sort of down dip limits of it in Theta West, we've got 400 feet of over 400 feet of pay in gross section in the pipeline well that's hydrocarbon bearing. That is, you know, we are the only people with the 3D that can see this. That's it. No one else has this data. We are the only group in the world that can actually see this anomaly, map it out, and we've captured a big chunk of it in the last lease sale, and because we've already owned a part of it prior to the lease sale on our acreage. That kind of feature, as I was saying before, that kind of feature, that kind of anomaly with that well into it, would be anywhere in the world would be classified as a discovery. We are working, you know, working on this really hard to get a total resource analysis. It will hopefully get that out, you know, in the next few months.
Thank you, Bob.
Now I'll turn it over to Michael.
In the next few slides, I'll talk about the shelf margin deltaic. Talk about that because it's a very exciting reservoir and because it's further progressed of our portfolio. And so this is the next one I can bring you the results on. I'm very happy to be presenting the results of a lot of our analysis. Jay spoke earlier of location in Alaska, and I wanted to highlight that again. What you see on this slide in the yellow are some of the outlines of our projects. And 3 key points I wanted to highlight on this slide. First of all is the size of these projects relative to the size of what's discovered up here in Alaska. You know, you see the enormous fields of Prudhoe Bay, but you also see the enormous, by any standards, fields of Horseshoe and Alpine. And our reservoirs parallel these reservoirs in aerial extent for sure. The second point I want to highlight from this slide, as discussed earlier, is the Dalton Highway and the fact that we have infrastructure over our reservoirs. When we're working in cold, remote tundra, I cannot overstate the impact of having a highway right there accessible. That's year-round, maintained access to all of our reservoirs without having to do extensive ice roads, without having to do permitting and gravel campaigns. So we're very excited about that. And then the third thing to highlight from this, as discussed earlier, is just the resource density. To have reservoirs like this in such a density that we're able to see through our seismic efforts and that we can access through the highway, it's a very exciting time for us. To zoom in a little bit on this area and talk a little more about the reservoirs, these polygons here roughly represent 4 different reservoirs that I hope to discuss. The top polygon on the right is the Alkaid development. As earlier presented, this has been progressed the furthest. This is to flow test and contingent resource status. The green shown on the far left is the Talitha Kaparic. That is in the works. The bluish on the right is the slope fan. That is also in the works, and there's a lot of reason to be excited about both of these. But sitting above these, and the one I'll discuss in more detail in the coming slides, is the shelf margin deltaic. Bob spoke of this earlier, but the image you see here is the petrophysical interpretation of the Pipeline State well. The shelf margin deltaic, as earlier mentioned, is the shallowest of the reservoirs shown here. And it's easily identified by this blocky sand shown in the lithology on the left-hand side. In this case, it's 450 feet of sand, which makes up about 20% of the 2,200-foot column of oil that we see in the Pipeline State well. Shown on the right-hand side here is the east-size lithology map with reservoir contours in it. We have several analogs to this reservoir on the North Slope. One that's been in the headlines a lot lately is the Horseshoe Picka well, and that is a direct analog to this reservoir system. The one that I'm very excited about to apply as an analog is the Alpine field. I'm very excited to apply that for several reasons. One, it's made 500 million barrels to date, as Jay mentioned. Second, it's very analogous in reservoir properties and in oil quality. The Alpine Reservoir contains a light sweet crude very similar to what we have in our Brookian interval here. But perhaps the most exciting reason to use that as an analog, or the most valid reason to be excited to use that as an analog, is the G&G personnel responsible for the Alpine discovery are the G&G personnel that founded Eastsize and have done a lot of the work on this and have produced the map to the right. The Alpine, or the Alkaid discovery, was my first time finding 1 billion barrels, but the people who brought the Alpine discovery to fruition, they've done this before successfully, and we're very excited to be working with them. This map they produced on the right affords us the ability not only to see where the reservoir is, but also to target the better sections of the reservoir. And our development plan is tailored to do that. What you see in this map is the shape of the reservoir, but you also see the red intervals that indicate the better reservoir sections and the gold intervals that indicate very good reservoir section. Also notable in this map is the Pipeline State Well. And as you can see, the Pipeline State Well isn't in the better sections of the reservoir. There's a lot of reason to believe we have significant upside as we move from the Pipeline State into the better portions of the reservoir. And our development plan is meant to capture exactly. For the development plan, we've worked at International Reservoir Technologies, very good reservoir engineering firm. We're grateful to have them working with us on this project. The development plan applied to this reservoir concept is very lucrative even at today's market. The term that's been used is almost frighteningly robust, but the economics are very robust. We see today's strip price applied to the reservoir produces strong economics, and we're happy to be presenting them. A few things I'd like to highlight. The well orientation is very significant for this development plan, and it's shown here in the development pad on the left-hand side. Each of these pads will have a similar development or well plan applied to them. The reason I like to highlight this is this development plan is not aggressive from a drilling and completion standpoint. These are not long reach laterals. These are not very intensive completion strategies. But this development plan is an exceptional development plan applied for a light, thin crude in enhanced recovery situation. And so what happens is the longitudinal fractures on this orientation create a true line drive water flood. And so your injector producer combination results in high efficiencies of recovery in these fields. Alpine is forecasted to achieve well over 40% recovery. And we expect our results to be very good as well. This is a wonderful application for this line drive water flood. And what you see here shown in the table at the top is that through the two phases, targeting first the best portion of the reservoir and then second the good portion of the reservoir, we can develop approximately 20,000 acres. The full development plan is about 170 wells, and we forecast it to produce 376 million barrels over the 30-year life of the reservoir. The two different producing sections, phase 1 and phase 2, were forecasted separately to account for different reservoir properties. Phase 1, we anticipate wells to produce with an IP of 3,800 barrels of oil per day. Phase 2, we anticipate a production of 2,100 barrels of oil a day per well. And then subsequently, the EURs for these wells, 6 million barrels in phase 1, 3.2 million barrels in phase 2. These numbers are validated by the Alpine field. We've taken direct analog from this in both development plan and in reservoir and in oil. And so it's very easy to lean on these numbers and say they're justified by looking at our direct analog in the basin just to the north of us. To summarize our development plan and the highlights, we discussed earlier 20,000 acres developed with 170 wells and about 376 million barrels produced. The peak rate for the development is forecasted at 90,000 barrels of oil a day. This is a very high number, but very realistic when we compare to the analogs on the North Slope, and thus a lot of reason to be bullish about these numbers because there's so much evidence that production capability is there in our neighborhood. The development plan takes 8 years to develop the reservoir, but we forecast 30-year life of the wells. And as mentioned earlier, very robust economics with an NPV10 of about $5.75. As a second check on the reasonability of these numbers, we've done a probabilistic standard oil field practice. This is a Monte Carlo simulation applied to the reservoir parameters as seen in Pipeline State Well and using the analogs of the Alpine, the Horseshoe Pika, the North Slope analogs. And so when we do this resource estimate through a Monte Carlo simulation, we see a P50 number right here of about 1.8 billion barrels of oil in place, 483 recoverable, and a P mean of 1.9 billion barrels of oil in place, 511 million recoverable. So as a resource estimate, the 1.8 to 1.9 billion barrels in place with 500 technical recovery, very good affirmation of our development plan and an affirmation of the deliverability of the reservoir.
And Michael, we'll be having a kickoff meeting later this week to talk about turning this over to Lee Keeling and Associates to do a engineering report for us.
Thank you, Jay.
So moving on quickly, I know I'm looking at the time and we want to have some time for questions. East Texas, it's subordinate to Alaska. We're focusing all of our resources on Alaska. You can see why. It's incredible. I mean, we're talking about, Michael, was just one zone of 450 feet in a down dip portion in that super trap for the upper portion of the Talitha reservoir, that shelf margin deltaic. We do have a technical review that we're working on in Alaska. All of our wells are currently shut in at current prices. They're not economic. We had a slight blip up in natural gas prices last week, but since then they've come back down. We own 100% of the leasehold. There is some small minority interest in some of the wells, but not significant. And we have had an independent expert, Michael worked with him and Art Berman, to analyze well performance issues. We believe it still offers great potential in a higher commodity price environment, but it's going to remain secondary to what we're doing in Alaska. Now, this is a slide that also I asked Art to put together, and it's break-even prices, including G&A and facilities for lots of fields around the world. And our break-even, these are based on our 2 projects that we have right now. Our break-even at Alkaid is high 30s. Our break-even on the Talitha shelf margin deltaic is the mid 20s. That's how good the reservoir is. So when you blend those together, you get something about $30 a barrel. Our G&A is pretty small. So these are on project level numbers, but I assure you, if we add G&A into it, it'd be probably less than 50 cents a barrel, much less than that. And you can see that we are on the far right-hand side of all of these. Immediately to the left of Pantheon, Alaska, is Guyana and the North Sea, the Buzzard Field in the North Sea, and the 2 large Exxon discoveries offshore Guyana. You can look at some of the other major fields. The Eagle Ford in Texas is about 1/3 of the way up the curve. The Marcellus is in a similar position. The Marcellus has benefited because of their location. They're real close to the markets in the Northeast. Going further, it's the Bakken, which is just under $60 a barrel, the Haynesville, which is about 60, going up to the Fayetteville and the Barnett. The Barnett was the original shale play around Dallas-Fort Worth Airport that kicked off the whole shale boom, and you can see what kind of numbers they need. So the E&P industry cannot survive on $25 or $30 oil. It doesn't work. The companies that have debt repayment coming this year are going to be have serious issues rolling over that debt. I'm sure most independents are probably not making a positive cash flow unless they've got a very good hedge book. I can tell you that in Texas, the gasoline prices have not come down very much, so the integrated majors are trying to hold their margins by keeping the downstream prices up, although I'm sure that their volumes are way, way down. But the key for this is to just show you in a relative sense that Pantheon, Alaska, given where our infrastructure is, and we didn't mention it, but when we drill our next Alkaid well, we can put that well on production almost immediately. We can get a long-term test. It'll allow us to do things that no one else can do in terms of reservoir analysis and sizing our facilities and all of the things that you want to do and really should do to maximize the performance of a reservoir. We have stacked pays. We have, as a new term that we talked about today, in the hydrocarbon density that we have in our area. We're sitting on about 80,000 acres, some of it with incredibly thick reservoirs. So these reservoirs are going to be developed even in a fairly low oil price world. So just to these are the numbers I talked about earlier. You can go through those. They're out of the Saudi Aramco IPO data set. 2888 break even. In summary, well, you know that the work is ongoing. The work with Bob and Michael have talked about. It is, no one's sitting back. We're pretty good at working remotely. Most of us work remotely anyway. Alkaid and Talitha are economic based on the current forward curve. As we mentioned earlier, a very, very large national oil company was chasing us last week to get the NDA signed so they could get into the data room. What do we have? We have several world-class assets. They have multi-billion barrel potential. These assets will be attractive to any size company. I assure you this will move the needle for anyone. As Michael said, the location affords year-round activity, which is unique in Alaska. The two of the 5 reservoirs across Greater Alkaid and Talitha that we've identified have the potential of 120,000 barrel a day peak rate and over 500 million barrels recoverable. That is significant. And it's 200 wells for development. And let me tell you, I've been in a big oil company. What do you like to do? You like to employ capital, especially in today's environment that would be rapid payback and in conventional reservoirs, and watch your money grow. So the remaining 3 reservoirs, as Bob mentioned, are being worked. We're going to embark with Lee Keeling on the shelf margin deltaics to do their work there, and that is ongoing. Before we take any questions, this is a picture of our really, really good friend Bob Caddo and myself on the neighbor's F-12 rig about 4 or 4.5 years ago in Polk County in East Texas. Bob Caddo passed away over the weekend. We lost a great friend. He was a great supporter of the company. Bob was truly a giant in the small cap resource arena in London, and he had an incredibly loyal following. And as I was thinking about Bob, and I'm sorry, I'm going to miss the 5 a.m. calls. Bob knew I got up very early, and he'd often call me at 5, and if he didn't catch me by 5:15 or so, I'd usually be in the gym. And if he called while I was in the gym, it was a no cell phone area. And I'd hustle home and I'd call Justin and I'd say, Justin, Bob called me. Do you know what he wanted? And about half the time he would, and about half the time he wouldn't. But I'm going to miss that because he was such a friend and such a gentleman. And I just want to say, Bob, we're really going to miss you. So sorry. Justin, you're going to take over and do some of the questions, right?
I am Jay. Look, guys, I'm very conscious of the time. We've had a lot of questions come through. I've got a list of about 75 or 80 questions here, and including some that have come through live during the presentation. Many of them I think we've passed through during the presentation. So what I'll do is I'll highlight the ones that I think are the key ones that we haven't addressed. In the interest of time, I'll whiz through the ones that are very easy to answer, and I'll direct the other questions to the most relevant person. And the first question, and the most obvious one, is the farm out. It's the first question on everybody's mind, particularly given the movements we've seen in the oil price, the movements we've seen in the equity markets. And the question is, how are they going? Jay mentioned that, of course, we'd be naive to suggest that they haven't been impacted by what's gone on. None of the companies have told us and have rang us up or contacted us to say that the projects are stalled. But of course, the first thing that anybody would do is look at their own assets in this environment and just focus to make sure their own house is in order before they start looking at anything else. What I would say, and Jay slid over it on the last slide, we've had a national oil company sign an NDA last week. That's after the oil price fall and after the Saudi-Russian political games and argy-bargy of the oil price have occurred. So as you saw in that chart that Jay spent some time going over, these assets appear to be on the lowest end of the cost curve. We all need oil. The oil market will go on. The oil's been in the ground for 80 million years or more. It's not going to go away. And in any oil price environment, these are the attractive ones. They're conventional in nature, which is important. And so to answer the question on the farm out discussions, they're ongoing. We've seen no direct impact, but it'd be natural respect that timing would possibly be impacted. Flicking through the other questions, there's a bunch of questions about our estimates on the resources and things. I think we've covered those off pretty nicely. A very relevant question asks about the costs in the services sector. Do we expect to see any significant costs? Michael, would you mind just letting me know what you've modelled into your models for any cost reductions that we expect to come through?
Yes, gladly. Tried not to overextend any estimate of cost reductions. So we've modeled in about a 10% cost reduction with services. There's certainly indication that prices are coming down, but we're trying not to be overly optimistic about cost reduction. So to date, it's a 10% reduction model.
Great. Okay, that's great, Michael. So the point is we've seen an order of magnitude greater than that fall in the oil price, but you've been reasonably conservative in modelling in the cost reductions. The other question is break even. Jay mentioned in one of the recent slides, I think he mentioned for Alkaid it's a little below $40 a barrel, and for Talitha it's sort of just above the mid-20s per barrel. Again, attractive in this environment.
And those are flat prices. Those are not increased over time. That's a flat price.
There was a very good question talking about the bombed out state that many oil stocks have found themselves in, particularly over the last couple of weeks, and how it would impact our farm out. For example, would we consider different terms? Would we consider taking stock in a company, for example, instead of a cash up front? Bearing in mind, we've mentioned that there's been over $200 million invested on our assets, and we've, as you've seen from this presentation, the advanced stage that some of them are in, we'd be expecting an element of cash as an upfront payment in addition to a carried interest, carrying our costs of drilling. And I think the answer is we'll listen to anything, particularly at this moment in time. We know that the markets are tough, and that includes looking at a potential farm in for the whole the whole asset base, versus separating them into more discrete projects. We've spoken about Alkaid. Alkaid, we've got a leak healing report packaged up alongside that, so that's a really neat one to start off with. So we'll look at, the answer to the question is we're open-minded to consider anything. Of course, we wouldn't take stock in a little, penny dreadful sort of junior stock, but if it was a super major coming and offering a stock at well, maybe it's something we'd consider, but we haven't had such an offer. But the point we're making to shareholders is that we're open-minded. There's a question here, and these are in no particular order because they're as they've come through, but there's a question there about the assumptions in Talitha versus Greater Alkaid. Michael, I think that you mentioned potentially much higher recoveries in Talitha because of the superior reservoir qualities. Did you or perhaps Bob want to answer that question?
Yeah, I'll quickly before I turn it over to Michael. One of the things that we've been doing is especially over the last few months, we've been working on this really hard, is high grading where we expect to see better reservoir in these different projects. It's particularly in Talitha. We've been doing that, and I think we've got a handle on it in the shelf margin systems track. So being able to turn that sort of high-graded reservoir potential over to Michael, and Michael is able to model it and put in better recovery factors and use different analogs. So when you see that we have a P50 of, let's say, 500 million or 480 million recoverable in the shelf margin deltaics at Talitha, but we're talking about 365 million barrels or so recoverable. That's because what we've done is high graded the better part of the reservoirs, which means that in the phase 1 development and phase 2 development, you can, you're accelerating the value of the project. Anyways, I'll turn it over to Michael.
It's an excellent introduction on the reservoir side. When we look at the enhanced oil recovery, especially in the or as Bob mentioned, development plans we applied are meant to capture better recovery. We see in the North Slope analogs in excess of 40% recovery quite regularly, and we even see some in excess of 60 or 70%. We're certainly not estimating the high end at the moment. We're estimating very achievable recoveries, but we are excited that through high-grading the reservoir and applying enhanced oil recovery techniques like miscible water injection, alternating gas, enhanced recovery, we expect to capitalize on the better reservoir recoveries that we see.
Thanks, Michael. Just swiftly moving on, and again in no particular order, there was a few questions, perhaps more macro in context relating to Alaska specifically. One question was that Alaska, being so dominant on the oil and gas business, would have been adversely impacted by the oil price, and the question that's been asked is whether or not management would see or are expecting the Alaskan state government to raise taxes perhaps on production and leases. And look, it's not our job to speak for the Alaskan government, but from everything we've read and been aware of, we think that any discussions for things like that are more limited to production from these large legacy fields. Jay mentioned Kaparik and Prudhoe Bay. These are the two biggest fields in North America, in fact, obviously both being next to each other in Alaska, and they were both put on production, I believe, in the early 70s. So we're not aware of any discussion to the smaller companies, and in fact we'd point to the grants that the state of Alaska put in place, or the tax rebate scheme a number of years ago, trying to induce new activity into the state of Alaska, trying to induce activity to hopefully assist companies in finding discoveries and therefore benefiting from the economic multiplier effect. Whilst we're on the concept of Alaska, another question came up mentioning that we had some leases coming up for expiry in next year in 2021, and asked about the extensions of those leases. And just I put this question to our Chief Operating Officer, Pat Galvin in Alaska, and we can disclose that we're in the middle of, we've started the process of unitizing certain of our projects in Alaska, and those discussions should begin to crystallise this half of 2020, and we'd hopefully they'll be finalised towards the end of the year or in early 2021. So that process of unitisation is very much underway. There's a couple of more questions here which I'll pass through. One of those, Michael, and there's a number of questions here about logistics, just the act of drilling, given location and proximity to infrastructure. And I think it's a really important point. I mean, there is a number of questions, but perhaps a general conversation might be best. One of the real advantages of this project, both financial and operational, is this proximity to the infrastructure. Both the pipeline and the highway run, in fact, underneath our Alkaid prospect. Michael, could you give a brief, and I mean the word brief, explanation of just what those advantages mean in terms of how we would go about drilling our various prospects? There were some questions suggesting that, for example, Talitha is further away from the road than Alkaid, but again, all of these are closer than we're seeing in some of the other, in all of the other projects on the slope. But could you perhaps give just a bit of an explanation of what those advantages are and how it would impact our drilling?
We got to be quick, guys. We got 1 minute left.
Oh, okay.
The primary advantage is we can work when other people aren't working, and that's probably the biggest. So we have our choice of crews and equipment that are sitting on the sidelines. It's very exciting that we can be just a short distance off of the haul road when everybody else has to work off of ice.
So Michael, is there anything else that you wanted to say on that question of drilling logistics in Alaska, and perhaps how you may go about drilling the various projects?
Yeah, I could give a little more color as well. The Alaskans are very good at extended reach drilling, and that originally came about because you're trying to have the minimum surface impact but reach the maximum reservoir. So directional drilling has been in vogue here for many, many decades, something like 30, 35 years, and it's done very well. And so we don't need a lot of reach from the Dalton Highway to have some fairly good reservoir. There's still appropriate application for ice road use, but above all, the haul road support from the Dalton Highway, the ability to sell oil by truck and the ability to place gravel immediately, gives us advantages of picking the equipment we want, operating in the time frame we want, and being able to reach most of the reservoir we want just about any. So we can really lever that to optimize our cost structure by picking up equipment that isn't utilized at certain times of the year, and by ensuring that we minimize our costs by not operating in the expensive winter season, but in the relatively easy summer season.
Fantastic. Thank you, Michael. Another question coming through, and I'll probably go through, I guess, 4 or 5 more, I think should capture most of it. This relates to East Texas. Jay, the question is, times are difficult. The oil and gas prices have fallen and Texas is less attractive than it was. And clearly, even if it was attractive, the sheer size and scale of this emerging Alaskan portfolio that we have has meant that Texas has become very much second place in the portfolio. And the question is there any chance that we perhaps may sell that off or farm that out in this environment? Jay?
Yeah, it's unlikely that we could sell it off under the current price environment. I don't think that's practical. We've looked at farm outs in the past. We have talked to a couple of companies about farm outs. I don't think in the current environment with the gas price down around $1.50 an M, and most of our projects are heavily gas dependent, that we would get anyone to come in for a farm out.
Yeah, thank you, Jay. Look, there's a couple of other questions here, which for obvious commercial reasons we can't answer. Questions asking questions of specific other operators up there in the North Slope, whether or not we have been speaking to particular companies or anything like that. And I think we're just unable to answer those. There was a question on in this environment, obviously preserving capital. Do we need to raise money? And the answer is no, we don't. We signed off our annual accounts in the last month with a signed audit report, for which, of course, we had to prove a going concern. Which meaning you have at least 12 months cash in the bank. But of course, we're conscious of the oil price and what's happened, and we're conscious of financial markets. So, one of the things we are doing, like every sensible company in the world at the moment, is watching our costs very carefully and working out where we can reduce those costs going forward. For those that saw our published results recently, our cost of sales in Texas was reasonably high. Those wells have all now been shut in, so we expect the costs for Texas to drop considerably. And again, just general prudence. We're being very, very careful with what we're spending, and we will be running through the whole business as another project going forward, just working out where we can cut costs like any sensible company in this environment. Probably one last question, and it's an important one, is the team. We've been very fortunate to have some very, very skilled and very experienced people in this team, one of whom is not on this call today, and that's Philip Gobe, our chairman. Philip ran Prudhoe Bay for ARCO, who was the joint venture partner with BP back in the day. So we've got a huge wealth of experience in Alaska. Philip also sits on the board of Pioneer Natural Resources, the biggest Permian player, and he's also recently been appointed as the chief executive officer of a company called ProPetro, who I believe, Jay, is, if not the biggest, one of the biggest providers of fracking services to the Permian Basin.
Yeah, they are the largest pumping provider in the Permian.
Yeah, and Jay, despite being very fit and handsome, yourself, Philip, and Bob, above 50. So, a question is, do we have any succession planning in place or key man insurance, or is there any concerns? And if I can mention, or perhaps have a go at answering that question first, Jay, what I would say is we're building a team, a very careful team, so there is replication of services. We work very, very closely together. We have management meetings, in fact, every single week with the whole board, unless somebody can't attend. We do what we can to make sure there is a transferring of abilities and a knowledge, a knowledge redundancy built in. Jay, is there anything that you wanted to add to that?
No, I really would just like to say that with a small team, and we had 3 of our 5 board members on this call, and 3 of our 5 full-time employees on this webinar, that we have incredible depth with a very, very small team. And we do not intend, I've talked extensively with Michael about our operations and how we will operate, and we're not going to build up a large operating group. We think we can stay small and keep our overheads down, even in an environment where we're producing hundreds of thousands of barrels of oil a day. Michael, would you like to comment on that?
I think that's well said. The right structure, fit for purpose up here doesn't have to be a large group. I'm very excited about the depth we have, and I'm very excited about the bolt-on depth that we have within reach. We have a great team that's helped us achieve the success of the Alkaid recently, and I think that we're in a good spot to operate lean, ramp up to handle further operations with the consultants that have helped make us successful in the past.
Thank you, Michael. Look, one last question I think can wrap most of it up, and then I'd like to just pass over to Bob, if I may, for a final word on something. The final question talks about our share price, which is it's an obvious question. Globally, E&P companies, as well as other companies, have all been severely hammered in the equity market. And the question was, are we concerned about the share price? And look, as management of a company, of course we're concerned about the share price. Thankfully, it hasn't been on huge volume. But I'd remind everybody to take a step back and just think about what you heard today. Is the story sound? Are the assets of good quality? We have no debt. We have a clean capital structure. We have strong, supportive shareholders. This project is conventional. It's not unconventional. Remember that chart that Jay spent some time on, comparing this project to other projects? Guyana, North Sea, and all across the US. This is at the lower end of all of those. Think about what's happening with Saudi and Russia. We saw Saudi 2 days before they announced they were going to ramp up production, in fact, trying to agree with Russia production cuts because they want a higher oil price. And when the Russians didn't play ball, of course, that's when the war started. We've got low royalty rates. We're in North America, low sovereign risk. It's onshore, despite the fact of these being offshore targets, they're onshore. And that's one of the questions I wanted to mention to Bob in a second. And of course, we're expecting to see oil service rates, servicing costs drop. Alaska is a long-term play, so we're exposed to long-term oil prices. Again, even if we did a farm out deal tomorrow and started drilling, in the next 12 months, we may have 2 wells on production, but we've got hundreds or thousands of wells that can be drilled from this asset base. So it's about the long-term oil price. And I'll leave you with one comment that I picked up. Bill Armstrong from Armstrong Oil and Gas on the 25th of February this year picked up a chunk of another company up there, and he quoted, this is quote, "The Nanashuk, which is the Brookian play on the North Slope of Alaska, is currently the world's hottest conventional onshore play." And we're positioned smack bang in that, the closest of all the companies to the available infrastructure, which is a fantastic advantage for us. Bob, I promised I wanted to leave with you, if I may. You've constantly flapped your arms around to me about, sort of shaking me about the size and scale of this thing, and just why you're excited. We had a conversation, in fact, over the weekend about how it's evolved even better than you'd expected. I'm not talking about grandiose hyperbole numbers, but just what is giving you this great comfort as a geologist, as our chief technical director? What is giving you the real excitement about where we're finding ourselves today, despite the share price? Because it strikes me that it feels like we're in a parallel universe right now.
Look, what we've been talking about, I think the whole message of today has been that we have enormous traps with, where we know we have a large volume of oil in place. We have the seismic data, we have the well data, we have, all that information in place to say that, this is world class. I mean, it really is world class. These are targets that people are exploring for in the deep waters of West Africa, Guyana. This is the scale that people are going for. But we already know in the projects that we are highlighting and high grading we already know we have oil in these targets. It's there. I mean, and not only that, but like at Alkaid, we've tested it. So I mean, it's a unique situation in the world. I mean, it's we've got high resource density. We've got these large accumulations. They're stacked on top of each other, and and we have underutilized facilities that are screaming for hydrocarbons. That pipeline is 1 million barrels of spare capacity in it. There's nowhere in the world like that. And then as unique as the North Slope is in terms of Bill Armstrong talking about it's the #1 onshore play in the world, which I agree with. We are unique as Pantheon in that play because of our proximity to the pipeline. I mean,
Bob, I would just add all of the other players that have made exploration announcements of discoveries are going to have to spend hundreds of millions of dollars, if not more, to get their first barrel of oil out and into that pipeline generate
exactly, Jay.
Cash flow.
It's billions. I mean, Conoco's talked about 3 billion. Armstrong, Repsol, and Oil Search have talked about 2 to 5 billion barrels. I don't, to development. Everybody has to put these wells on horizontal, long-term tests, fracture stimulation, And we can actually go out and start testing, doing that and putting it on production immediately if we had the capital. I mean, we're just unique. I mean, it just is unique. So that's why, absolutely, that's the reason why we're excited.
Yeah. Bob, look, I'm conscious of the time. Thank you very, very much, Jay, Bob, Michael. I think we've done a pretty comprehensive presentation for everybody. We will be putting a copy of this onto our website so people can access it later on. Of course, we did our best. I did do my best to answer as many of those questions as possible. Anything, people can contact me directly if they've got any other questions. But with that, I think we should sign off. Thank you, everybody. Unless anybody has anything else to say, I think we can probably sign off for now.
Thanks, Justin. Goodbye, everyone.
Thanks, everybody.